Hello and welcome to the Currency Exchange, NatWest Markets FX podcast, where we help to break down the major themes and events driving markets this week and in the weeks ahead. Today I'm joined by Paul Robson, who is our European G10 Head of Strategy here at NatWest. And this week was all about US March CPI inflation, and it certainly did not disappoint. Paul, what did you make of the reading?
Well, expectations were certainly high in the market that this data release was going to be important, and it certainly didn't disappoint. We went into the release thinking that inflation month on month might come in at sort of high 0.2. Market expectations was for 0.3. I actually think the whisper number in the market, away from the economists, was probably for slightly less than that. But ultimately, it came in at 0.4 on the month. Now, that might not seem a big number, might not seem a big miss, but it's uncomfortably high for the Fed that has seen inflation over the last couple of months come in higher than expected. So January, February numbers were higher than people were hoping for. And now we've got a March number that is also high. I think people could sort of discount the numbers at the beginning of the year. List prices can be adjusted, and that's not something that repeats itself through the year. So maybe it carried on into February, but we're into March data. And the economists who thought that these numbers would be coming down relatively quickly will be disappointed, and I'm sure that the Fed will be equally disappointed. I think the other way to look at this release is what it means for the Fed's preferred measure of inflation. So that's core PCE deflator numbers that we'll get at the end of March, the 26th of March to be exact. And did the components of this week's upside surprise in inflation, will it mean that the core PCE deflator numbers are equally high and therefore, again, uncomfortably high for the Fed for comfort? And there's a little bit better news here. So medical services and motor insurance numbers, they were stronger than expected, but they won't feed through into the core PC deflator numbers that we'll get later. There was some upside surprise in transport costs, but they have a relatively low weight in the other index of inflation. So maybe when we get the core data that the Fed will be focusing on, maybe it just won't be as high as we've seen, and therefore a little bit of comfort for the market. So we might get some retracement of the moves that we've seen.
I guess the most important thing for the market is what it means for the Fed, right? When and by how much the Fed can actually start easing by. Did this change our view in terms of how much the Fed can actually start cutting by?
Well, it certainly changed the market's view of the Fed cutting cycle through the rest of the year. Markets took out a full quarter point of easing from the Fed, and I think we got down to a lower 40 basis points in total for the expected loosening in interest rates, monetary policy this year. It's come back a little bit to 46, but the data have led us and our economists team to revise their Fed call. So they now expect 75 basis points of loosening from the Fed this year. They think that the Fed starts in September. They had previously expected June. In terms of the sequencing, 25 in September, followed by perhaps a 50 in December, or just quarter points cuts in September, November, and then finally in December. There's a little bit of issue around politics, November's presidential election, and from my point of view, I think the Fed is almost damned if they do, damned if they don't. If they don't cut because of the election, because they don't want to be shown to be biased, then there's going to be someone saying that, well, you should have cut. And equally, if it's the same where they do cut, people will be saying, well, you should have waited for the election result. Now, the Fed has gone before a presidential election, but I think ultimately the Fed will just prioritize the health of the economy, its mandates, and if it thinks that inflation is coming down and the economy is slowing, they will cut rates. So a change of call, an important, as you said at the top of the call, an important number, and it's impacted market expectations.
Yeah, we definitely saw, the dollar really react to that was so much stronger, off the back of US CPI. But I wonder, do you think market is overreacting in the strength that we saw in the dollar? Or how does it change your longer term view on the dollar?
Yeah, I don't think the market is overreacting. I think it's an important number. It does shift market expectations for the Fed. We were tactically short dollars running over the next couple of months, and we've turned neutral following this release. Now, I do think the dollar will be lower by the end of the year than we see it today, but we're just going to need a little bit more confidence. We need confidence that inflation is coming down and the economy is weakening to justify looking for the dollar to turn immediately lower. Now, we have got a little bit of evidence that that's coming through. So, like you say, everyone was focused on CPI this week, but there were some indicators from small and medium-sized enterprises that are really, really struggling. And these are these companies that drive employment growth in the US economy. If they're struggling, then ultimately the rest of the economy will start to weaken. So I don't think you're going to get a lot of follow through in this dollar strength, because I think interest rate expectations are fully priced. When you think about our 75 basis points of easing, that's actually more easing than the market has currently priced. I think people probably already own the dollar as well, and simply the dollar is expensive on a long-term basis, and there's only so far you can push an expensive currency even higher. So neutral for the dollar now, but doesn't really change the longer-term outlook.
There is another big central bank on the other side of the Atlantic that everyone is kind of on the edge of their seat, waiting for them to start the easing price cycle, and that is the ECB. And we obviously had their rate decision on Thursday. Do you think there was any new information, or what were your key takeaways from the policy announcement?
Yeah, I don't think there was a huge amount to take away from the April ECB policy meeting. Obviously, they didn't change rates. We didn't expect it. The market didn't expect it. And of course, the central bank, or the governing body, the governing council, had already guided really quite strongly that they didn't really want to consider cutting interest rates until the June meeting. They had new economic projections. Quite frankly, they could have justified cutting in March with the old set of forecasts, and they could have cut today, given the inflation numbers are coming in lower than expected. But they seem very keen to wait for updated wage data, for example, and new economic projections in June. And nothing we heard today really shifted that. I was interested to hear what Lagarde said about the pushing back of Fed rate cuts and whether that would influence their own thinking in terms of when they should be cutting interest rates. And here that she pushed back really quite hard that the ECB outlook was a function of the Fed. She was talking about different inflation profiles, different growth profiles, different points in the cycle. But she did say that they would be sensitive if the pass through from FX weakness into inflation, and that would be something that they would have to build into their forecast. So the elastic between the Fed and the ECB can be pulled a little bit, but it can only be pulled so far. But at the moment, it feels like the ECB is on track to loosen policy at the June meeting and unchanged. So as I say, not a huge amount of takeaways from the ECB.
Yeah, I think that's a great point about, there is a limit to how much monetary policy can diverge. And I guess it's the FX rate that really kind of plays into that. Wondering what is kind of the main takeaway from the euro for the exchange rate from this meeting?
Yeah, I think that for the currency, it's monetary policy is going to weigh on the currency for a little bit. I think that the fall in that we've seen in euro dollar down to 107, I think that that's justified because of rate expectations and relative yields. I would caution against thinking that euro dollar collapses here down to parity. Obviously, back in 2021, we had quite a sharp move. We had a 100 basis points shift in relative rates, and the currency dropped 10 cents in that period. But I think people have to be mindful of what else was going on the last time euro dollar broke 107 and went sharply lower. And that Europe was in the middle of a once in a generation energy shock. 100%, 200%, 300% increases in energy. Europe was having to import energy, and a current account surplus for the euro area was decimated into a big deficit. Now, energy prices have come sharply lower, and the balance of payments position has improved. And it means that you're just going to get net corporate flows at the extremes. And of course, 107 feels like quite low. And I'm sure there's plenty of European corporates that might think about repatriating money. And of course, relative to the euro area's surplus, the US obviously runs a big deficit. So these flows can be quite large. And I don't think the shift in relative monetary policy is enough to get euro dollar sharply lower. So I think it's going to be range bound for now until we get evidence that the Fed can start easing. And certainly the medium term outlook for policy for the Fed is still pretty weak relative to the euro area.
I wonder, what do you think are going to be the main drivers of FX markets going forward? Or is it just going to be that question of, FX markets are really just waiting for the Fed to start easing?
Yeah, I think one of the key takeaways from this week is that, again, it's that elastic between the Fed and other central banks. And if I look at the example of the Bank of England, markets priced out as much easing from the Bank of England than they did for the Fed. And we didn't really have any important UK data this week, and we didn't have really important central bankers making speeches, but people had a one-to-one move in UK short-end interest rate expectations and the Fed. And I wonder whether that's really right, because central banks are independent. Of course, there's some kind of linkage through the exchange rate. If the US is growing more strongly, then world growth might be a little bit stronger. Global inflation might be a little bit higher than previously expected. But to justify the moves that we've seen, I just don't think that that's right. And so we might get some of these adjustments from a range of currencies. And that's something that I'll be watching out for to see what impact it will have on currencies. The other one, I think, is increasing evidence of policy divergence within Europe as a whole. So regular listeners might remember that I've been talking about the late cutters in terms of interest rate policy and the early easers. And I think the evidence of the last couple of weeks supports the idea that you're getting divergence. You're going to have the Bank of England, you're going to have Norges Bank, who are a late cutter, and you've got the ECB, the Ritzbank, and the SNB that are early easers. And monetary policy divergence, I think, is going to matter. So I still think the Swiss franc is going to be, for example, one of the weakest major currencies this year. I think the Swedish krona might underperform a little bit, although there's another story about property sector risk premium, but that's probably for another day. But policy divergence in Europe and markets challenging this idea that everyone has to be tied to the Fed. And I think you've just got enough data divergence, independent central banks, and that might be challenged over coming weeks and through the rest of April.
Yeah, I think that's a great point. It's not all about the US dollar and the Fed. And that is probably about all we have time for today. Paul, thank you so much for joining us. If you did like the podcast, please do click like and remember to subscribe so you get the latest episode first. Thanks again.